Does having insurance change individual self-confidence? Recent research in contract theory on the effect of behavioral biases implicitly assumes that they are stable in the sense of not being affected by the contract themselves. In this paper, we provide evidence that this is not necessarily the case. We show that in an insurance context, being insured against losses that may be incurred in a real effort task changes subject self-confidence. Our novel experimental design allows us to disentangle selection into insurance from the effect of being insured by randomly assigning coverage of the subject revealed whether they want to be insured or not. We find that uninsured subjects are underconfident, while those that obtain insurance have well calibrated beliefs. Our results suggest that there might be another mechanism through which insurance affect behavior than just moral hazard. Self-assessment and belief matter in decision making and contract design. Optimal decisions depend on correct self-assessment and beliefs that are not systematically biased. One important example is self-confidence in own ability and performance. In particular, overconfidence has been established as a relevant aspect in individuals' economic behavior. For example, overconfidence has been found to predict excess market entry of entrepreneurs, the risky investment decision of CEOs, and speculative trading. In the context of insurance, Sandroni and Squintany, 2007, consider the Rothschild and Stiglitz 1976 model in the presence of overconfident individuals. They find that if the share of overconfident types in the population is large enough, compulsory insurance isn't Pareto optimal anymore. It follows that overconfidence as a behavioral inclination has important implications for contract design in several settings. While the majority papers focus on the case of overconfidence, situations in which individuals are underconfident are also researched. Imperfect self-confidence calibration relates to many effects observed in human decision-making. However, a general interpretation of the literature on self-confidence is that over or underconfidence are comparably stable traits, at least within a certain decision environment. That is, one can be overconfident when driving and underconfident with math tasks, but overconfidence when driving should not be affected by the color of the car that one drives. This paper provides evidence for self-confidence to be malleable in a setting that has relevant implication. Our focus here is an over and under placement as a specific form of over under confidence. Larrick, Burson, and Sol 2007 define the degree of an individual's overplacement as the difference between her perceived and actual percentile in the distribution of performance within a group. It differs from other concepts of overconfidence in that it depends on the expected performance of others. We show in a laboratory experiment that self-placement depends on whether people acquire insurance or not. While insurance in our setup partially covers potential losses from bad performance in a real effort task, it should be unrelated to self-placement for rational decision makers. At the same time, we find no evidence for more overconfident individuals choosing more or less insurance in the first place. More specifically, we implement an experimental design that allows us to disentangle effect from the incentive provided by the insurance contract from effect coming from selection into the contract. In the insurance context, the former is known as the problem of moral hazard and the latter as the problem of adverse selection. Before attempting the real effort task, individuals are given the choice to buy the insurance contract. Conditional on this choice, actual insurance status is randomized, that is, whether one obtained insurance or not is based on a random draw, and individuals are informed about their insurance status throughout the experiment. Our design is similar to the one used in the credit market field experiment by Carlan and Zinman 2009. Their idea is to attract borrowers with an advertised interest rate and conditional on showing up in the lender's office to randomize the actual interest rate. However, Carlan and Zinman 2009 are not able to impose an interest rate that is higher than the one advertised, as borrowers could simply walk out of the experiment. In a laboratory experiment by design, there is no attrition. This allows us to assess whether the effect of insurance on relative self-assessment only comes from feeling unlucky when actually not achieving it. Remember, insurance status is based on a random draw, or whether there is another mechanism that is consistent with the effect. A related design is used by Bo Foster and Peterman 2010, who let individuals vote on a policy that allows punishment for defection in a prisoner's dilemma, but then randomize the actual implementation of the policy. Our real effort does involve the forecasting of numbers with the help of two Q values. This task fulfills two requirements for our purpose of creating a realistic insurance setting. First, the ability for forecasting, which might in the present case be related to math skill, varies sufficiently in the sample to create different levels of confidence in own ability. Second, the participant effort can influence the precision of their forecast and thus their relative performance. Scrum and Sonnemans 2011 also consider insurance choice by varying various parameters such as the number of available contracts. However, in their setting, losses occur without a subject's influence, which may not be realistic for some insurance contracts such as car insurance. Previous experiments studied insurance choice with exogenous loss in various settings. See for example Ganderton, Brookshire, Mackey, Stewart and Thurston 2000 and Laurie, McInnes and Swarthout 2009. Our design naturally exhibits features of insurance markets outside the laboratory such as adverse selection and moral hazard, but of course it has to abstract from some features of real-world insurance market. Self-placement is measured as the difference in an individual's self-assess and true performance rank among all participants within an experimental session, regardless of whether they had insurance or not. The elicitation of the self-assessed rank is incentivized by rewarding accuracy. We find that on average, insured individuals have well-calibrated belief about their ability relative to others, while those individuals that do not have insurance underplay themselves. These results are in line with experiment by Clark and Friesen 2009 and Murat, Sefton, and Stormer 2016, who argue that the use of real effort tasks and incentivized confidence elicitation leads to a lack of overconfidence, which is generally observed in better than average prediction. Moore and Chain 2007 and Husel and Rusticini 2005 find that subjects tend to underplace themselves in tasks that are perceived as difficult and where performance is low in absolute terms, which is also true for our setup. Mew and Proger 2015 study socially derived answers, and they show that the social context increase bias behavior. Thank you.